Today we're going to go through how to run a producing property economic model on Drillnomics. I'll go ahead and log in. I'll see the Overview tab here, and my projects will automatically generate here on the left side. I'm going to go ahead and add a new project. I'm going to call this the Producing Test and save. Drillnomics will automatically generate that project over here on the left side, and it will be highlighted. Now go to the Overview tab. If you want, you can include all the seller information, property information, and summary information, or you can skip that for now. That will just be added to the report functionality at the end. The acquisition I'm looking at is a producing model, so I'm going to select Producing Property Model. It's going to have an effective date of April 1, 2015, so I'll leave that here, but you could also change that if the effective date was in the past or future. And in this case, I think there's also additional development possibility, so I'm going to also create a type curve for PUDs, or Proven Undeveloped Properties. Now I'll go ahead and hit Select Files. I've already uploaded to my computer a DRI file of two wells, the Chavez A and Chavez B wells that I'm looking at acquiring. I'll go ahead and select that from my computer, hit Open, and Drillnomics will automatically upload the data and normalize it into the program. Once that's done, the Production Analysis tab will be selectable. Go ahead and select that tab, and you'll see here that you now have the Chavez 4A, the Chavez 4B, and the PUD well as wells where you can edit data. We'll go ahead and start with the 4A. As you can see, Drillnomics automatically determines the date of first production, and from what you input gives you your effective revenue start date, so you can just leave those alone. Now we'll go down here, and you can see that the default type curve is a little bit high for this well, so I'm going to go ahead and change it to try and fit. I think I'm going to flatten the curve slightly and add a little bit of decline, and go ahead and recalculate. I think that looks pretty accurate. We'll go ahead and do the same thing for gas. As you can see here, the gas started off pretty low, but has changed over time, so we're going to go ahead and try and model it to get the current type curve based on the more current data. I think that looks pretty good overall. Obviously here the point is how easy it is to change your type curves until you're comfortable that it accurately represents your wells. Once you're satisfied with your well, go ahead and move on to the next one, in this case the Chavez 4B, and do the same thing. Just fit the curves here in the exact same way we did for the last well. Once you're satisfied with your curve, on both of the producing wells you've input, go ahead and move to the PUD well. Again, a PUD well is an undeveloped property that you think will be drilled in the future on the asset you're evaluating. In this case, you can now select another set of files that you think are representative wells of what your potential PUD well would be. So in this case, I'm going to choose the same wells that we've already evaluated, the same exact file, since I think those are the type of wells that would be drilled here. If, however, you were evaluating vertical wells and thought that horizontal wells would be drilled, you could pull in a different data set of horizontal wells in the area to build your type curve. Now we'll just do the same thing we just did for the other two, and we'll build a type curve for our PUD well. Once you're satisfied with that curve, and you've evaluated all the wells, you'll see that Financial Analysis tab is now selectable. So we'll go ahead and go to the Financial Analysis tab. Here, you'll have the same thing. You'll have the 3 selected wells, the 2 that are producing, and your PUD well, and you'll need to go through and run a financial analysis for each. In this case, we don't know the NGL yield or gas shrink, so we're going to hit zeros for that, but we do know that the BTUs, million BTUs per MCF, are equal to about 1.4, or what would be called 1400 BTU gas in this wet gas play. We'll go ahead and update. Next, we'll go to the net revenue. In this case, we're looking at a 320-acre lease with 100% working interest and 80% NRI for all wells. So we'll go ahead and hit 80 for the NRI. Next, we'll input our pricing. You could use the strip table if you'd want, typing in the strip values for oil, gas, and NGLs if applicable, or you can just use flat prices. I'm going to use flat prices here just for the sake of time. Our oil differential, being the difference between the price at the wellhead and the market price, is about $9 in this area, and the gas differential is about 50 cents. There's no NGLs, and typically NGLs won't have a differential. It will be baked into the price, so we'll go ahead and put 0 in for that. We're going to go ahead and raise the oil and natural gas price by 2% per year. We'll go ahead and update. As you can see, Drillnomics automatically builds a pricing table based on that information, and just like all tables, it's done by year. If you want though, you can expand each year to show you monthly data so that you can double check the numbers. And that's the same on every table in Drillnomics. You can expand to monthly data. Next, we'll go down and see that production revenue has been automatically updated based on the production and the pricing. And now we're going to go in and input cost information. Our working interest, as I said, is 100% in this 100% lease. Our LOE in this particular case, we're estimating to be about $6 per barrel of oil since it's an oil-weighted play. And we're going to say there's a fixed cost of $4,000 per month of LOE. Our change in LOE year over year is negative 2% in our case. Because this well's already been drilled, we have no initial capex. Our abandonment cost, or the cost to plug and abandon and reclaim the well at the end of its life, is an estimated $125,000, and our tax rate is about 7%. We'll update that to get our net cash flow chart. Once we've gotten the net cash flow chart, we'll go ahead and determine our net present values for the well. As you can see, because you don't have any cash input on the front end, all of the NPV values are positive. Next, we'll go to the next well and do the same thing. Finally, we'll go and do the same thing for our PUD well. Our PUD well is estimated to have the same interest as the existing wells, so I'll go ahead and type in 80% NRI, just like the other wells. Note that because this is a PUD well and it will be drilled in the future, that pricing is very important. You'll want to make sure that when you have your pricing, you're ensuring that the price in the future is the price that you would expect, because that well will be drilled starting in the future. So if you expect the well to be drilled in 3 years, in this case, you're looking at an oil price, a net oil price of $46. a net gas price of $2.36, obviously higher than the $44 that we have today in this assumption. Again, 100% working interest. We'll use the same LOE numbers. In this case, though, since the well has not been drilled, we'll actually input the cost to drill, which I believe in this case is $4 million. Abandonment cost stays the same. Tax stays the same. And we'll hit update. Now we built the financial analysis for both producing wells and the PUD well. One thing I should mention is that if you look at one of the producing wells, all numbers in the table start from the effective revenue date. So as you can see, your Chavez 4A well is expected to produce 1,132 barrels and 7,000 MCF in the first month where you are receiving revenue, not the first month the well was drilled. So the table is starting only once you start receiving dollars. Once all these wells are built out in the financial analysis, the Build Out Model tab will be selectable. Go ahead and select that tab. You'll see that the Chavez 4A, the Chavez 4B, and the PUD well all have value tables now that have been input to the build out. We'll go ahead and select numbers for the Chavez 4A. For producing properties, we'll typically go somewhere between a PV8 and a PV15. So in this case, I'll select the PV10 for both of the producing wells. This is obviously based on your own company's economic assumptions and value propositions. Next, for the PUD well, as you can see here, we are not going to include that well in the value yet. However, what we will do is go down here. For new well, we're going to add a type well. It's going to be the PUD type well. We're going to go ahead and click Add New Well. And as you can see, we're going to be able to model a future PUD well being drilled. I'm going to go ahead and model this for being drilled in January of 2017. Same working interest in NRI, and I'll hit Calculate. Now we can choose a PV for the value of the PUD well to be drilled in the future. For PUD wells, I typically go with a a higher PV, really, a more discounted cash flow than a producing well. So we'll go with a PV15. Once you've selected all those items, Drillnomics will have modeled them down here at the bottom. So as you can see, in month 1, which would be April of 15, we're going to receive $43,000 in royalties from the 4A and $37,000 from the 4B. That's our estimated amount. Obviously, these wells have already been drilled, so there's no capital cost. So it's just a pure positive cash flow. But then once we model the PUD well, you'll see that we have an expense for our PUD well, well 4 in this case, which would be net, basically the drilling costs less your first month's revenue. So $3.6 million in this case. Then you see that the cash flow goes up substantially because that well has been drilled. But basically, this is modeling all of your cash flows from these wells. And as always, you can change the scale in the graph to whatever you would want it to be. And Drillnomics will always show you, as you drag your cursor over it, what the projected revenues are to be. Once you've done that, you've completed your financial model. You can add as many PUD wells as you'd like if you think there'd be more than just one drilled, but in this case, I think it's just one. We'll go to the report generator. Drillnomics automatically takes all the information you've input, which, as you saw, we did not input all the summary data. You could go back and input that and it would automatically generate all of that here. But it does show all of your oil production for all the wells that you have, and shows you all of your economic parameters. It's quite useful, and then you can go ahead and download a PDF if you'd like,